In our relentless pursuit of financial freedom, we often find ourselves grappling with the age-old dilemma. How can we make our hard-earned money work for us, rather than the other way around? Enter Tom, a diligent soul who, through his everyday job, managed to save $15,000, a nest egg that ignited his desire for financial independence. As he delved deeper into the realm of finance, Tom stumbled upon the alluring world of dividends, opening a world of possibilities that promised to transform his $15,000 into a golden ticket to financial freedom. Keeping cash on hand is undoubtedly beneficial for instant liquidity, but in an inflationary environment, it can be akin to watching your wealth erode before your very eyes. The best way to keep your cash from losing its worth during times of high inflation is not to let it sit idly by. Instead, you can harness the power of dividends, putting your idle cash to work by investing in dividend stocks with a rate of return that outpaces the inflation rate. In this captivating journey, we will unravel 3 investment strategies, each outperforming the one before, and illustrate how much you can earn from these opportunities in 1 year, 10 years, 20 years, and even 30 years down the line. But that's not all. We'll also reveal how you can combine these strategies into a diversified portfolio, creating a safe investment haven while still generating an impressive monthly income. Do watch till the end, as you won't want to miss out on any of these strategies. Before we dive in, I want to remind you to hit that like button and subscribe if you haven't already. It really helps my channel grow, and I appreciate your support. Strategy 1. The first strategy on Tom's list was covered call ETFs, which offer investors a unique opportunity to earn income from both stock appreciation and dividend payments. But how does this work? A covered call ETF is a special kind of investment fund that buys certain stocks and also makes special deals called call options, offering the right to buy a stock at a set price within a specified time frame. By continuously making these special deals on the stocks they own, these ETFs aim to generate additional income for their investors. When you invest in a covered call ETF, you can effectively participate in these special deals without having to lift a finger. The fund does all the heavy lifting for you. The beauty of these ETFs lies in their ability to provide income from both dividends and option premiums, resulting in a more stable and reliable stream of passive income. However, it's crucial to understand that covered call ETFs come with inherent risks. Options may expire worthless or stock prices may decline, impacting the overall performance. Nonetheless, well-known covered call ETFs like QYLD, XYLD, and RYLD have demonstrated their potential, offering dividend yields ranging from 9.27% to 12.5%. If Tom were to invest his $15,000 solely in these covered call ETFs, with an average dividend yield of 11.27%, he could potentially earn up to $1,690 in dividends by the end of the first year. But the real magic happens when Tom reinvests these dividends, allowing the power of compounding to work its wonders. The dividend snowball effect. In 10 years, Tom's initial $15,000 investment could grow to $43,639, paying him an annual dividend of $4,918, or roughly $410 per month. Fast forward 20 years, and the same investment could swell to $126,955, yielding an annual dividend of $14,308, or $1,192 per month. And in a staggering 30 years, Tom's initial $15,000 could balloon to a whopping $369,346, paying him an annual dividend of $41,625, or a monthly income of $3,469. The reason behind this compounding increase in dividends lies in the dividend snowball effect. When you reinvest dividends by buying more shares, you'll receive a higher dividend payout the next time around. This allows you to buy even more shares, further increasing your future payouts. This process repeats and grows over time, much like a snowball rolling down a hill, accelerating the growth of your investment and the dividends it generates. Strategy 2. Next up on Tom's list is REITs, real estate investment trusts. Think of REITs as a savings group for real estate, where people pool their money together to buy buildings like offices, malls, or apartments. The money earned from these properties is then shared among the investors, like Tom, who contributed to the pool. Historically, REITs have shown solid performance, with an average annual return of 10% over the past 20 years. This makes investing in REITs a smart way for Tom to grow his wealth while earning a steady potential income. One great advantage of REITs is that, unlike regular stocks, they often pay dividends every month, making them an attractive choice for those seeking a consistent income stream from the stock market. It's important to note, however, that the amount of money you get from REITs can fluctuate, as it depends on factors like rental occupancy rates and the overall economic climate. While REITs can offer higher returns than regular stocks, they also come with inherent risks when the economy is not performing well. Some of the best REITs for investors include Arbor Realty Trust, ABR, with a dividend yield of 12.25%, Orchid Island Capital, ORC, with 16.92%, and Invesco Mortgage Capital, IVR, with 17.08%. If Tom were to invest his $15,000 solely in these REITs, with an average dividend yield of 15.4%, he could potentially earn up to $2,310 in annual dividends by the end of the first year.
But wait, there's more.
If Tom reinvests his dividends for the next 10, 20, or 30 years, the dividend snowball effect kicks into high gear. In 10 years, his initial $15,000 could grow to $62,827, paying him an annual dividend of $9,675, or roughly $806 per month. In 20 years, the same investment could swell to $263,152, yielding an annual dividend of $40,525, or $3,377 per month. And in 30 years, Tom's initial $15,000 could balloon to a staggering $1.1 million, paying him an annual dividend of $169,740, or a monthly income of $14,145. While REITs offer the potential for higher yields, they also carry inherent volatility risks, making them a more speculative investment compared to some other options. Strategy 3. The third strategy on Tom's list is the creme de la creme of dividend-paying stocks, dividend aristocrats. These are special companies within the S&P 500 group that not only regularly distribute cash to their shareholders, but also increase their payments every year for at least 25 consecutive years. Investing in dividend aristocrats is considered one of the safest and smartest choices for those seeking a reliable income stream. These companies are champions of stability, often selling products or services that people need regardless of economic conditions. Their ability to consistently increase dividends year after year is a testament to their financial strength, sound management decisions, and sustainable growth. Some of the best dividend aristocrats in the market include ABBV with a 10-year dividend growth rate of 14.1%, Visa V with 18.05%, and Broadcom AVGO with a staggering 35.28%. If Tom were to invest his $15,000 solely in these dividend aristocrats, with an average dividend yield of 1.79%, he could potentially earn a measly annual dividend of $268 in the first year. But the true power of dividend aristocrats lies in the long-term compounding effect with its remarkable dividend growth. In 10 years, Tom's initial $15,000 investment could grow to $131,838. Fast forward 20 years and the same investment could swell to a staggering $886,672. And in a mind-boggling 30 years, Tom's initial $15,000 could balloon to almost $6.6 million. As you can see, the higher the dividend yield, the more pronounced the dividend snowball effect becomes, accelerating the growth of your investment and the income it generates. The power of diversification. While each of these strategies offers its own unique advantages and potential for growth, Tom may not want to expose his entire investment to a single specific strategy. After all, diversification is a crucial aspect of risk management, helping to mitigate the impact of future uncertainties and market fluctuations. To address this concern, Tom can create a well-balanced portfolio by combining all three strategies, effectively spreading his risk across multiple investment vehicles while still reaping the benefits of their collective potential. The beauty of creating this diversified portfolio is that it not only allows Tom to earn higher returns, but also keeps his investments relatively safe. By spreading his risk across multiple asset classes, each with its own unique characteristics and performance drivers, Tom can mitigate the impact of potential downturns in any one sector or strategy. This approach strikes a delicate balance between growth potential and risk management, providing Tom with the best of both worlds: the opportunity to generate a substantial passive income stream while maintaining a level of stability that aligns with his long-term financial goals. You may also wish to check out my other video on the 10 buy and hold forever dividend stocks in the link above and in the description down below. Have you thought of how much dividend income you need? Comment below. If you enjoyed this video, do like and share this video so that more people will learn about how to generate dividend income from $15,000. Check out this playlist of my top 10 videos for creating wealth, and I'll see you in the next video. Take care.